Today is Friday, September 16th, and this is the ADM Investor Services Weekly Market Review. Today's guests are Alan Bush, Senior Financial Economist here at ADMIS, and Steve Freed, VP of Grain Research. Steve, what did the USDA September U.S. World Corn, Bean, and Wheat report say, and how has the market responded?
The USDA always has some surprises for these monthly reports, and the first thing they did was they did lower the corn yield, but not as much as the market had hoped for, so the funds added to their short positions. They estimated a record soybean crop here in the United States and record demand, and the funds are trying to defend their long position in the beans. And in the wheat, they continue to show large supplies of wheat in the world, and the funds added to their short positions.
Any word on early U.S. corn and bean harvest yields versus the USDA estimates?
It's interesting, it's very early, but soybean yields are better than expected, suggesting that their 50 bushel record yield in September could be increased. And the corn yields are just a little bit below what farmers had hoped for, so maybe the corn yield can still drop a little bit.
And any news on demand for the U.S. 2016-17 corn, bean, meal, and wheat exports?
We had a good week in export sales, but corn prices globally are coming down, so we might start seeing a slower demand for corn. Wheat demand this week was lower than we had hoped for, so we're kind of losing some of that business. Soybean demand is good, but China's on holiday, so we might lose some demand there. And the market's pretty disappointed in the soybean meal demand. It's lower than people had thought. So in general, we're seeing demand slow down a little bit. And as far as South American weather is concerned, right now it's dry. It's seasonally dry in Brazil right now. We haven't got into the rainy season yet. Most people are looking for kind of a normal 2017 year, maybe a little dry in Argentina, but it's kind of still early to guess. But right now it looks like a normal year for South America.
And what is Hightower doing in the markets?
I think in talking to Hightower, he's a little bit concerned about the U.S. economy, and that it might be slowing down. And there could be various reasons, but one of the things he's looking at is while there's more people working, they're working at lower wages, so there's less disposable income, especially if healthcare costs go up. And so in talking to some of the shippers, they're seeing a slowdown in movement, they're seeing a slowdown in drawdown in manufacturing inventories, and a slowdown in manufacturing. So he's a little bit concerned about a slower economy. As far as the grains are concerned, he's trying to pick a bottom in the corn market. He's trying to buy March corn a little bit lower values than they are right now, thinking that we'll see a bounce after harvest. But he's long soybean put spreads, and he's trying to sell November soybeans, thinking that the spread between beans and corn needs to narrow a little bit.
And Alan, yesterday it was reported that August retail sales fell 0.3%, which compared to expectations of a 0.1% decline. Why did the 30-year Treasury bond futures decline on this normally bullish news?
Well, basically that's a sign of weakness for the bond market. If it does not rally when it should on that type of bullish news, it's an indication that something is wrong. Possibly inflation is starting to come back to some degree, which we believe is the case globally. So to us, it's a clear sign that the bond market is likely to head lower and that inflation around the world is starting to work a little bit higher.
And the Japanese yen continued to fall on the belief that the Bank of Japan is considering taking negative interest rates in Japan even more negative. The Central Bank of Japan will hold a policy meeting on September 20th through the 21st. What is the outlook for the Japanese yen in light of increasing prospects of more accommodation from the Bank of Japan?
Well, we have to be bearish on the yen. If they're going to take rates even lower into more negative territory, it makes the interest rate differential advantage that the dollar enjoys even more of an issue and more of an attraction. So we would have to believe that the yen is going to continue to decline, and very likely at their next meeting that they will be adding more stimulus in the form of negative rates or more negative rates. In fact, a recent survey showed that over 50% of analysts that were asked thought that there would be more accommodation at next week's Bank of Japan meeting. So the yen will probably work lower.
And what is the outlook for stock index futures if the Federal Reserve increases its Fed funds rate next Wednesday?
Well, of course, if the Fed does raise rates next Wednesday, that would be very bearish short term. But I think that that would be a gift for the longs to come in and become buyers. Basically, rates are likely to stay low for a long period of time globally, and I think it would be a mistake for the Fed to raise rates, but if they did, it would be very much a buying opportunity, and I would think that ultimately we will see stock index futures recovering and trading at new highs for the move. So even though I do not think that the Fed will be raising rates, in fact there's only a 15% chance that the Fed will raise next week, the possibility of a rate increase poses as a very substantial buying opportunity if that does take place.
Great. Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.